Exactly. We're all debt junkies, governments in particular. But it's not just governments, it's the whole of the private sector globally. $350 trillion of debt is basically the bill for all debt. The worrying thing at the moment is that government debt, public debt, is accelerating for all the well-known reasons. Aging populations, greater defense spending, outlays on Medicare, Social Security, these sorts of things. I mean, these are the critical dynamics. If you want to be in a paper currency, maybe the dollar is the best of, a bad bunch. It's the cleanest shirt in the laundry. The biggest risk by far is inflation. The Fed is ignoring it. Equity investors are so far ignoring it. I mean, quite rightly, but it's a hurdle we've all got to clear. And valuation levels will be pared back downwards. Markets will be derated lower in a higher inflation environment. That's the real danger. We've seen it many, many times before.
Hi, everyone. I'm Maggie Lake, and today I'm talking macro with Michael Howell, the managing director of CrossBorder Capital. Hi, Michael. It's wonderful to have you on the show.
Hi, Maggie. Very good to be here. Lots to talk about.
There is. It's been a historic week. But before we jump in, I thought it might be a good idea to give everyone a refresher on why liquidity is such an important metric to track when you're trying to understand and figure out what's happening in financial markets.
Sure. I mean, the whole origin of looking at liquidity actually goes back, a couple of decades or more when I was at Salomon Brothers, the US investment bank. And Salomon was basically a firm for people to know that principally was the bond markets globally. And tracking flows of funds was really the critical thing to understand, to try and gauge how interest rates were likely to move and how fixed income markets, would gyrate. So there's been a long legacy or history of actually looking at liquidity, certainly from my perspective as an analyst. Just look back over the last 2 or 3 years, and I think most people would recognize that liquidity in some form, whether it's the Fed's QE or QT or whatever, has really been critical to the understanding of markets. But I think if you want a theoretical foundation as to why this is going on, just think how the nature of capital markets or financial markets has really changed in the last couple of decades. And when we pick up an economics textbook or a finance textbook, it says capital markets are all about interest rates and financing new capital spending. Unfortunately, they're not anymore. They were at one stage several decades ago where interest rates are important and markets raise money for new investment, but actually they're not anymore. What they really are debt refinancing vehicles, actually massive debt refinancing vehicles. Something like 3 out of every 4 transactions going through world financial markets now is effectively a debt rollover of some form. So if you're looking at debt rollover, refinancing, and there's $350 trillion of debt out there, and something like 70 trillion needs to be refinanced every year. You need balance sheet capacity. Balance sheet capacity in the financial sector is what we think of as liquidity. And if you don't get that balance sheet capacity, you don't get that liquidity, what happens is you get refinancing crises. And that's basically what we can see littered, over the past 2 decades of basically crashes and, GFCs or whatever it may be. It's all about refinancing, the lack of refinancing anyway. So that's why
that makes sense.
Vital.
Is that because we are all so many governments are just carrying these massive debts that they've funded, and they, in the same way we've got to pay the interest on our credit cards, literally have to come up with the money to pay the interest?
Exactly. We're all debt junkies, governments in particular. But it's not just governments, it's the whole of the private sector globally. $350 trillion of debt is basically the bill for all debt, private and public. The worrying thing at the moment is that government debt, public debt, is accelerating for all the well-known reasons. Aging populations, greater defense spending, outlays on Medicare, Social Security, these sorts of things. I mean, these are the critical dynamics. And what you're getting is very strong debt growth. And what do governments do? They just basically kick the can down the road, and the interest bill is simply added to the debt pile. Debt is never repaid; it's rolled over. That's the problem.
So when this happens, and this is very important, I think, because if we're going to talk about what's happening now, we're trying to game out what that means for our investments. So when we have these crashes, or what's going on in the liquidity market that creates a situation where you see something bad happen? Is it just is it rates going too high? Is it a lack of liquidity for whatever reason? How does that impact it? So when you see those signs coming, you get concerned.
Yeah, I mean, I think the way to look at it is if you look at this pile of debt, the pile of debt, 350 trillion, stands in a fairly constant relationship with the pool of liquidity. And actually, if you do the math, it's something about 2.5 times. If that comes out of equilibrium, so there's a lot more debt relative to liquidity, then you tend to get refinancing crises. If there's a lot of liquidity relative to debt, you tend to get asset market booms. That's how that extra liquidity is dissipated through the system. What we've had kind of unusually for much of the last 4 to 5 years, although it's felt like it clearly at times, is too much liquidity relative to the debt. There's been a lot of liquidity. The problem that we're moving into, or the world we're moving into now, is there's increasingly demands on that liquidity pool. First of all, from what people think of as the maturity wall. So a lot of debt was refinanced during the zero interest rate or low interest rate regime around COVID. Debt was sort of extended in maturity and pushed out, to be repaid in 26, 27, 28. But we're starting to move, through the calendar now. We're getting closer to that period. So the first instance of that debt will start to be rolled over probably around mid 2025. So you're starting to see an increasing demand coming out of markets for this debt rollover, and that will, soak up liquidity, excess liquidity in the system. The other bogey we've got to deal with is the inflation one. And if inflation starts to pick up, even 1% or 2 percentage points on core inflation, that still is going to start to absorb liquidity from the system, because the real economy will start to demand more cash or more credit to finance increasing inflation, an increasing wage bill or increasing prices in stores, all these things. And those are really the problems. So I think that if you look into 2025, I mean, we've been arguing after having been bullish for much of the last 2 years, things are going to get a little bit tougher over the next 12 months. I mean, we still believe that investors can make money, but it's no longer going to be plain sailing. A lot of the easy gains have been made now.
So, and we're going to dig into the reasons of that, but it sounds like there's certainly a narrative that's out there that, between central banks easing and uh, countries trying to, like China, trying to stimulate, which we'll get to in a moment. Now we've got all this fiscal spending. We have a new U.S. president that's pro-growth. That there's a narrative where I think some people are under the impression that we're going to be awash in liquidity. People are pumping money, spending all this fiscal spending. It sounds like you do not see that. It's going to get a lot harder.
Yeah, absolutely. I mean, lower interest rates don't necessarily mean there's more liquidity in the system, for sure. Much the same way as over the last few years, increasing interest rates haven't meant that liquidity has been scarce. So I think you've got to disassociate the two things. They're very different. The pool of liquidity may be expanding, that's for sure. Make no mistake, it probably is. But on the other hand, the demands on that liquidity pool are growing significantly. If you get a stronger economy, particularly a stronger economy with higher inflation, that's going to take a much, much bigger bite out of that liquidity pool. And then if you get this debt refinancing problem, in other words, the maturity wall, that's also going to challenge the pool of liquidity. And then we have the wild card, as you suggested, which is China. And the thing to remember here is that China is basically a dollarized economy. It's a huge, huge dollar user. And if China's trade increases, I mean, maybe the unlikely situation, but who knows? Maybe it finds a way around, prospective tariffs. Then you're going to get increasing demand for dollars. And I think, we may be in a world, paradoxically, where the dollar could be quite firm. And because of the fiscal problems out there across the world and the monetization of debt, gold is strong as well. And that's an unusual occurrence to see both of those two factors strong at the same time. That's the irony. I mean, if you want to be in a paper currency, maybe the dollar is the best of, a bad bunch. It's the cleanest shirt in the laundry.
Which is so different than for so long people are calling and predicting the end of the dollar strength or dollar dominance even. But it sounds like that's going to be put off. You said something so important, which is I think that maybe what people are focusing is on the wrong side of the equation. And although the supply of liquidity is out there, it's going to be the demands on it that are really, it sounds like, we're the part of the equation that you're concerned about. So let's talk a little bit about inflation.
Mm-hmm.
So we have a new Trump won the US presidential election, and we don't know what the real policies are. We just know some of the rhetoric and some of the campaign promises that were made. Are you concerned that we are going to see rising inflation? Because we also had the Fed this week cut interest rates. So they seem to think inflation is under control. Again, we don't know what the actual policies will be, but how are you thinking about the inflation outlook?
I think the prospective Trump policies are not necessarily the problem. The problem is there anyway. That's not to say that the sort of policies that Trump may enact, such as forced repatriation of illegal workers, or the idea of slapping tariffs on a lot of goods, that's not going to help inflation for sure. But the underlying inflation problem was there anyway, and I think it's been a great surprise in many cases how the Fed has acted, over the last 12 months where they've broadly speaking been reluctant for most of the time to tighten policy. I mean, my old boss Henry Kaufman, who's the great sage of the fixed income market, said a few years ago, a Fed that starts talking about transitory inflation is a Federal Reserve that doesn't really want to tighten. And I think those are extremely wise words, and they echo down through the years now. And what we're seeing is again an example. I think if you look at what the Fed said yesterday at the FOMC, I mean, the reality is that inflation isn't really falling in the US. In fact, we're not really too sure, given the array of different gauges that the Fed looks at, what inflation really is. But we seem to be missing most of those gauges, whatever they are, and still the Fed cuts interest rates. We had at the previous FOMC, one FOMC member who disagreed with the policy. Now everyone's unanimous, which again seems kind of baffling. What explains this pattern? And it seems to me what they want to do is they want to ease policy. They want to cut interest rates. And the main reason for that is to probably try and cap the interest costs on government debt. And that is, of concern, I think, to the fixed income markets longer term. I mean, clearly it helps their financing or their funding in the short term, but it doesn't do very much for the long term because at the end of the day, debt is running out of control. And what you need is discipline in the system, and you need discipline against prospective inflation risks. And I think that's what we're starting to get. So, I'm sort of uncomfortable about this situation. And I think that, Jay Powell's statements yesterday weren't particularly helpful. There wasn't very much said about the Fed's reaction function. There certainly wasn't anything said about what's going to happen to QT or even the restart of QE, which I think is becoming paradoxically more and more important, particularly with this maturity wall coming up. So I think there are a whole host of unanswered questions out there, and inflation still ticks along at, I think, an uncomfortably high rate.
Do you think the Fed knows? Do you think they believe that inflation's falling, or do you think that they understand that they cannot raise rates and in fact need to lower them because of the interest payment and the debt wall that's coming, the rollover that's coming?
I
Because
think
they
that
raised them before, so they clearly, but is it because they're getting closer to that time? What do you think's going on? Or do you just think that they're wrong, that they're clueless and
no,
wrong?
I don't think they're wrong in the sense that I don't think they've misunderstood the situation. In my view, I think they're understanding it pretty well. And if you look at all the actions in terms of the Fed balance sheet, the Fed has been operating a regime that I've flippantly called not QE, where they're kind of denying that they're doing QE, but actually, if you look at what's happening to bank reserves or look at what's happening in terms of what we call Fed liquidity, that's clearly been on an upward course. I mean, that's why the markets generally have been pretty firm. There's a QE, a surreptitious QE going on. Also, simultaneously, Janet at the Treasury has been extremely clever in terms of how the issuance calendar has been skewed towards shorter dated tenors. I mean, this has basically, we think, taken almost as much as 100 basis points out of the long end of the market. I'm talking here of 10-year notes. They would otherwise, I think, be about 100 basis points higher. That's saving the US government $350 billion a year in terms of lower interest charges. I mean, these are significant numbers, and I think it's deliberate. And I think that generally speaking, the policy rate is no longer really the Fed funds rate. The Fed funds rate is almost the sort of residual. The policy rate is the 10-year note, or somewhere somewhere further down the term structure, because they need to focus on the term structure to keep the interest rate bill down. Now, if you start to work through the sort of the logic of this, what it really says is what happens, going back to my reaction function concern, what happens if inflation does kind of spike up to higher levels, and everyone is cognizant of that, particularly the fixed income markets? What can the Fed really do? Can it raise interest rates? what it ought to, but maybe it would find that difficult because the interest bill would then start to escalate significantly. And then you're in a situation where the debt GDP ratio really does start to spiral out of control. And the problem is we're at levels now where, compound interest, the compounding effect becomes actually quite dramatic. So these are the concerns.
So I
And
just want to, so yeah, so they can either tame inflation or they can manage the debt. They can't do both.
yeah, I think that's right. I mean, the sort of the irony in many ways is, I mean, if I was advising, incoming President Trump, I'd say what you want to do now is create a recession as soon as you can to try and get, people back into the fixed income markets. Well, good luck with that.
I mean, I think if you said that to him, his head would explode. There's no right.
Yeah.
First of all, to be fair, any political candidate is would have a very hard time wrapping their head around the idea, having just told everyone to vote for them, that they're going to create a recession and try to sell that to any populace. I think anywhere in the world, right? But particularly the election we just went through, where a lot of promises on the economy were made. So um, this tension between inflation and the debt, the Fed did just hike rates a lot in the last campaign.
Mhm.
Presumably the same pressure was there. So does that mean that they might, get serious about inflation again? We heard Powell talking about uh, Paul Volcker over and over again. Why were they able to do it then, and they might be reluctant to do it now?
Well, I think part of the issue is that, one is this compounding effect of a higher debt GDP ratio, and you've now got an interest bill, which I say is over $1 trillion, and it's getting bigger. Now, think of the math in this. What you've got in the next 12 months is about 30% of the debt, the outstanding debt, Treasury debt, will have to be refinanced, rolled over.
Mm.
So, the point is with going down the route of Janet issuing a lot of T bills and issuing very short dated notes, they're actually coming up for renewal quite quickly. Okay, the trouble is you've kind of got to run faster just to stand still in a sort of Alice in Wonderland world now, and that's one of the problems that we're facing now. If you think about that problem next year, and you've got a situation where you have to refinance 30% of the debt, the average interest rate on existing debt, the existing outstanding debt, is on average just under 3%. It's actually about 2.8%. So you're paying effectively $1 trillion on 36 trillion of outstanding debt. So it's about 2.8%. Now, the average interest rate across the curve right now is 4.3%. So they're going to have to pay on average a much higher interest rate bill, which means that if you're refinancing 30% of your debt, the whole interest rate bill, the interest bill next year is going to go up almost 20%. So these are mind, this focuses the mind significantly. Now, the other point that I would make is never say never, of course, on all this. And if you look at what's happening in Britain, across the pond, what's happened is there's been a new government in the last 6 months. A socialist government has come in. And what they've said is that, oh, look, interestingly, we found a black hole in the accounts. There's somewhere between 25 and 40, billion, which is basically missing, and that's got to be somehow closed. And therefore, we've got to hike taxes. Trump could easily say that there's sort of black holes in terms of funding in the US. There's several trillion missing. They've misdone the accounts, and therefore, because of the recklessness of the Biden administration of the Democrats, what we're going to have to do now is to start raising taxes. And then when he's made good, let's cut them again. Now, I think that's probably a long shot, but as I say never. These things are out there. But at the end of the day, this is becoming a problem. And I still think inflation is the major bogey to jump next year. And it's not that we're seeing 9-10% inflation rates. We're seeing nagging inflation, which is excoriating the market slowly.
Yeah.
And as
Well,
I
let's
draw the analogy, investors are sort of progressively being sandpapered to death, which is a sort of unpleasant analogy. But I mean that's what's going on. I mean you can't make good gains in an equity market where you've got yields progressively creeping higher and higher and higher. And
Well,
that's what they're doing.
let's talk about that, because I think that's what gets really important here, and it's important against the backdrop that we just saw a risk-on rally, right? And there's a lot of hope and enthusiasm I'm seeing all over social media, in Substack, everywhere, I'm seeing a lot of hopes and dreams about how wonderful this economy and what it's going to mean to the stock market. That's at odds at getting sandpaper to death. So I think it's important that people focus on this. Let's talk about the interest rates from when the Fed cut. And I know people like yourself who watch the bond market. Even though equities have been rallying, there's been a lot of concern about what's been happening in the bond market because even from the minute they cut 50 basis points, you didn't see any positive reaction in the bond market. Yields have gone up, not down. Now it's not a rocket ride, but it's been moving higher and then kind of stabilizing around here. What are you seeing in the bond market? What do you make of that? And what are you going to be watching moving forward?
Well, I think the bond market is troubling from a number of dimensions. I mean, number one, the question is who's going to buy the debt and at what price. I mean, that's clearly the big question. And what we're in is a situation now where in the short term the markets have been cleverly manipulated, I would say, because the traditional long term buyers of US debt, coupon debt. So we're talking here about pension funds or life funds. Basically have been, if you like, squeezed out of the market with a short-term shortage of coupon supply. So they haven't been able to get the stock what they want, which has artificially basically pushed prices up and yields down. And that's because most funding has been done at the very short end of the market. Evidence what happened in October when the Treasury issued almost $2 trillion of bills. Okay, these are big numbers. Against a debt of 36 trillion or thereabouts, 2 trillion 1 month in bills. I mean, these are, as Stan Druckenmiller noted, a year or so ago. I mean, the sort of figures we're seeing coming out of the Treasury are the figures one would have expected out of the old Argentina, not out of the US. So, this is a worrying thing. He is short the bond market for very good reasons, and he's very public about that statement. Now, I think that if you look at the inside the bond market, what you've got are two disturbing currents. One is that if you look at underlying policy rates, in other words, terminal policy rates, I think it's very, very difficult for the Federal Reserve to get rates down meaningfully against an economy that clearly is very strong. And with fiscal policy running at the clip it's doing, how on earth is the economy going to slow markedly? It's simply not. We keep getting positive economic surprises. They're all well deserved. The American economy looks to be, from an outsider's point of view, in pretty robust shape. So it's difficult for the Federal Reserve, I think, to argue for rate cuts. I think the other thing, which is again a wonkish concept, is what's happening to term premia. Now, term premia are the risk premia that bond investors demand for holding interest rate risk over the term of a bond. And the point is that those term premia have themselves been artificially suppressed. They're starting to climb. Term premia, for the record, are negative. Okay, you shouldn't get negative term premia. The textbooks tell you it's impossible, but we've actually had them. They're starting to move up now. So if you add, let's say, high and stable or constant terminal policy rates, underlying policy rates, to a climbing term premia, you're going to get bond yields which are going to be moving up. So you're looking at a yield curve which is steepening and probably delivering a bearish steepening. And therefore, let's look at who is buying or who is holding the bond market at the moment. Now, what you've got are three broad constituencies. The long-term funds, well, okay, they will have to buy. But the problem is there's got to be a lot more coupon. There will be a lot more coupon issuance after this little temporary window of shortage closes over the medium term. There clearly is got to be, you've got to fund $2 trillion at least of a federal deficit every year. So this clearly takes a lot of coupon issuance. And the long-term funds will have more than enough in that situation. The second thing is, what about foreign buyers? Now, if you look at who's buying US debt, I mean, traditionally, if traditionally is the right expression, it used to be governments who would hold US treasuries as a reserve asset. And two of the biggest buyers of those have basically been the Chinese and the Japanese. Well, they're not buying anymore. The Chinese are letting their holdings roll off. Now, if you look at the data, the TIX data published by the US Treasury, what you find is some of the bigger buyers that are coming in are coming from the UK or from Belgium, or they're coming from the Cayman Islands or whatever. These are basically hedge funds that are probably buying. And what's going on is they're using a basis trade. In other words, they're going long the cash market, short futures, and an arbitrage. Now, what that really relies on, A, it's flaky, and B, it relies on stability in the bond markets and low volatility. Well, hey, just look at the volatility in the Treasury market. Monitor the move index, which again is maybe a wonkish concept for many people, but it's vitally important. It's much, much more important than the VIX index because it's going to tell you what will happen in the future. If you have high bond market volatility, all bets are off in the equity market. Equity markets won't be able to push forward if bond volatility is high for a number of reasons. The most important is that collateral, and we live in a world where collateral is vitally important for credit supply. Collateral gets a much, much bigger haircut by credit providers in an environment where you've got high bond market volatility, because treasury bonds and notes are normally the collateral posted to a lender against a loan. So this matters hugely. And I think my reading of it is that everything the Fed and the Treasury are doing are trying to suppress yields as much as they can, cap the 10-year yield or thereabouts, and trying to reduce bond market volatility by increasing liquidity within the Treasury market. This is vitally important. It's more important. The integrity of the sovereign debt markets are the most important things that central banks and finance ministries look at. That's what they're doing. Just look for evidence of the British market at the time of the Truss budget debacle, back in September of 2022, where I think this bull market started. But that showed that the Bank of England, with alacrity, shifted from a QT policy to a QE policy overnight to protect the bond market, forgetting about inflation or anything else. These are secondary considerations, and this is why I think you've got to start, maybe believing that the Treasury and the Fed are doing something more than trying to set Fed funds rate. They're actually trying to use, as I call it, not QE, and not yield curve control. In other words, subtle sous la table policies to try and actually manipulate the markets.
Do you worry about a guilt-like episode here in the U.S.?
Well, I mean, I think the thing is that Panche, the UK, I mean, that was an extremely foolish move that was made, and I can't believe that the US would make anything like those mistakes. I mean, it was basically a budget that was just not costed properly. It was completely crazy. I mean, the people that did it were fools. But at the end of the day, that washed out of the markets, but it was clearly a marker as to what could go wrong. And I think it should be a wake-up call for policymakers to be actually a lot more prudent looking forward. But you're starting to see, I mean, this is just not, I emphasize, this is not just a US phenomenon. Bond yields globally are moving upwards. And that's because the fiscal situations right across the world, the Western world, are looking very, very bleak. And there's an awful lot of funding to go on. And as I keep coming back to, we've got this with debt junkies, okay? There are costs to doing this, and the costs are rising interest rates.
Yeah. And there's no margin for error, for policy error when you're in that kind of situation, as we saw in the UK. And hopefully you're right, but we are looking at Janet Yellen's not going to be here. And some of the people who've been, working on this, you're going to see new people in these roles. And so you just wonder and hope that transition is very smooth. So I think, and when we were talking about the guilt episode, I think most of you are listening understand that's when we saw that massive spike, because in reaction to the British budget that almost broke the gilt market, but obviously the Bank of England moved quickly. So bond vigilantes seem like they're back. I just talked to Ed Yardeni, who coined the term in the 80s, and he is still bullish stocks, but watching, and I would say worried about the bond market. And that's going to be something he's keeping a very close eye on. Does it feel like we're back? And I'm really interested to hear you say that the bonds are now being held by hedge funds, because the market in that environment, those kind of market participants tend to see weakness and push and test until something breaks. Are we in a situation where that is going to increase volatility in bonds just because of who's holding them?
Yeah, I think that's fair for sure. I mean, I think the nature of who are the bond vigilantes has changed. 30 years ago when Ed Yardeni coined the term, it was basically the asset allocators in long-term funds. Now it's more speculative and more aggressive hedge funds who are probably the bond vigilantes. Let me stress that they're the marginal buyers. They're not the biggest buyers, but they're the marginal. They're not the biggest holders. They're the marginal buyers, and so they're important. The marginal buyer sets the price. So I think we've got to be cognizant of what the risks are. But if you go back to looking at the move index is really a critical thing I'd say to watch. And currently, the reading on the move index, or the last reading I saw as of yesterday, was about 117. What does that mean? Well, the way that I read it, which is probably a very simplistic way, but I just knock a decimal point off that and just say, well, that's about 11 to 12% annualized volatility across the term structure and on an annual basis. So normally the move index averages about 7%. So that's saying about 7% on average bond volatility. So we're getting close to sort of twice normal levels of bond volatility, which is a lot. And when I was more active in the fixed income markets, a level of 150 on the move index was really a kind of switch the lights out time, and that was when you basically believed that the Treasury or the Fed had lost control of the Treasury market. Now we have spiked up even higher than that, 200 at different times, but it's been very, very short lived. But that's something that the Treasury will be looking really, really closely at. And 117 is not that far away from 150 in reality. And I think whatever it was a week ago, we're up at, or maybe less than a week ago, we're up at about 136 on the move index. So these are big numbers on the gauge.
Do you think that the action in the bond market is going to in some way dictate or handcuff any plans that a new Trump administration would have? Because there's a lot of spending, there's a lot of potentially inflationary plans on the table. Do you think that the bond market reaction could be strong enough, that signal strong enough that it actually may curtail or have an impact on what they're actually able to do?
Well, I mean, the plain fact is yes. I mean, if the interest bill is rising, their room for maneuver is clearly challenged. So it must have a serious effect. The I mean, the whole fact is that what you've got there is a situation where if it can't go on, it won't, and basically we're sort of reaching those thresholds. I think my view on this is that the equity market can live with rising yields for quite a long time, but there comes a point where it becomes a bigger and bigger drag. And that's why sort of, the analogy I draw is, enjoy the party, but dance near the door here. Things could go wrong, and we're reaching those sort of yield thresholds where problems arise. Now, my reckoning is that the sort of cleverness, if you like, of Janet in terms of her funding profile at the Treasury has probably taken about 100 basis points out of Treasury yields. So they should be nearer 5.5% than 4.5% right now, and that's the worry.
How high do you think they could go?
Well, I think the benchmark has got to be nominal GDP. I mean, that's what you'd expect. The 10-year to trade, or the long end of the curve to trade, somewhere near nominal GDP. So if you're saying that inflation is circa 3-4%, that's the sort of gauge I would think, and the economy is growing at something like 2-ish%, you're talking about somewhere 5 to 6% for starters. Without the risk of potentially an overshoot. Now, that's what I think is the sort of benchmark we should be thinking about. Now, already if you start to look at other factors, more conventional metrics, and I was interested that Jay Powell was saying that one of the things they look very closely at is 5-year inflation swaps. I mean, that's clearly something which a lot of the market does as well. But if we're correct that the funding skew has basically taken 100 basis points out of the nominal yield, then the break-even inflation rate in the TIPS market is actually running at about 100 basis points higher than stated. So actually already what you've got is something like implicitly somewhere over 300 basis points for longer-term inflation. That's well above their target levels. And again, if you look at the yield curve, which used to be everyone's favorite metric of an upcoming recession, if you add 100 basis points onto the long end of that yield curve, the yield curve never inverted. It may have been flat, indicating a sort of at times a sluggish economy, but it was never inverted, signaling recession. So I think there's been, if you like, distortion or yield suppression going on, which has affected a lot of these typical gauges or normal gauges.
Which is brilliant because it would explain why everyone got the recession wrong. Like why the yield curve signal broke. It didn't break, it was just manipulated
Yeah,
uh because of the character of the issuance that
yeah,
was sort of masking what would have otherwise been a much higher interest rate.
yeah. I think, but
Uh,
it's a very clever tactic by the Treasury. I mean, hats off to them.
right.
They've saved a lot in the interest bill budget.
But one that seems like it's run out of time.
Yeah, I think that's the problem now. They're sort of losing their grip on the market. They're only a certain amount they can do. It's like going on the booze. You're going to get a hangover at some stage, and you keep drinking, but at some stage, the sort of the you've got to pay the piper or whatever.
I have no idea what you're talking about, Michael, on that, but
You know what I
um,
mean?
yeah. So this is a very important conversation because, again, as I mentioned, there's a lot of bullishness and risk on, but it sounds like even though we may see stocks grind higher into year end, there are some major risks ahead. Is when we've seen this in the past, is there a corollary that we can look at? And how does it end? Is it inevitable that you have to have a recession and lower inflation in order to get the bond market back under control? Or is it going to be some sort of new tool and more overt yield curve control or something coming from the Fed that will do that?
Well, it's a lot easier. I mean, to raise interest rates, Volcker like, to sort of 15%, as he did in the early 80s. When the debt GDP ratio was down at whatever it was then, 30%. It's a lot more difficult when it's up at 110%, because you're going to start to. I mean, that interest bill really comes through and starts to power up the deficit and adds to the whole debt burden. So it's an extremely difficult call to do now, and that's why I think the Treasury and the Fed are challenged about raising interest rates. Interest rates kind of become a blunt weapon in all this for that reason.
What about on the
So,
fiscal side? Is that where it has to come from, the
well,
solution?
maybe that's right. Maybe what they have to do is to somehow rein in the fiscal side. Now, as you rightly say, that's sort of alien to the whole Trump philosophy. But it may be that that's what they've got to do. And perhaps, I mean, the left field event that the whole market is missing here is maybe Trump comes in and says, look, this is before we build a better America, what we've got to do is to get the whole fiscal situation in much better shape. And it's in worse shape than we thought looking outside. Once we've come in and examined the books, we realise that the Democrats did a really bad job in terms of their spending plans. It wasn't properly funded, etc., etc. There's this black hole we've got to try and close, and you need some tax increases near term, and we've got to
Mm.
rein back spending. That may be the case. I mean, maybe he pulls in Elon and they get rid of whole swathes of U.S. government. I don't know, but I mean, the fact is that if it as they say, if it can't go on, it won't, and we're getting near that point. And bond vigilantes are more and more suggesting that there is a problem out there. Yields keep rising, and that's the problem. It can only go so far.
Yeah, it reminds of that. Always reminds me of that famous story when Bob Rubin, apparently said to Bill Clinton, like, "Listen, you've got to get the bond market on your side," which was not it's not happy news for any politician to hear. So it would be extraordinary if that were to be the case again, in some way. Of course, we don't even know who the Treasury Secretary is, and Powell says he's staying, but we'll see. So. China, we kind of brushed on that, but I think it's really important to sort of plug China and Japan into this conversation before we wrap. Seems like there's a lot of disappointment around what China's done so far. What are you looking at and what are you expecting?
Yeah, I think in my view, it's way too early to say. We don't know, and there's a reason for that. I mean, the size of the packages have not been announced, but what's been hinted is that these are sizable fiscal packages. Okay, now what really matters in this context is not only the size of the packages, and I think let's be clear here. What you've got to do, I think, in the case of China, is to think of a package size that is equivalent to what the US did in the GFC. So we're talking of something like 2 to 3 trillion US dollars. So we're really thinking about 20, 30 trillion yuan of that sort of magnitude. Now it doesn't have to be announced on day one, but I think that we have to push in that direction, and that was what I'd say. Now that's, if you like, part of the answer. But the other part, which is way, way more important, is how is it funded? If it's funded out of existing savings, I don't think it's going to have anything like the desired effect. What needs to happen is it needs to be monetized, because China is suffering as well from a lack of liquidity. And it's the banking system which importantly needs to be recapitalized, and the banks need to buy this debt. Now, what the Chinese have announced is injections of capital into the state banks. And that tells us, I think they're going that will facilitate rather an expansion in their balance sheets. Now that expansion of the balance sheets may embrace increasing lending, but I think it's more likely to embrace increasing holdings of government bonds. And effectively the way has already been cleared for both the banks and, importantly, the People's Bank of China, the central bank, to buy more government debt. So I think that's giving us a taste of what may be coming in the future. So that looks a positive omen as far as I can see in terms of what China's doing. But this is early days, and we certainly don't know either size of the package or how they're going to finance it. And I don't think we're really going to know for another 6 months in reality. So investors can choose to invest in China and sort of hope this is going to happen. Many are. You can see that with the way the market's moving. But it's clearly a risky situation. What we come back to as well is the fact that China is a big dollar user. And if the Chinese economy revs up significantly, what you're going to see is more demands on the dollar. And that is going to use liquidity that could be used elsewhere. It's also going to underpin the dollar. I mean, one of the great paradoxes out there is whenever the Chinese trade surplus expands, the dollar tends to be strong. Now, economists say that shouldn't be the case, but the reality is that China is still denominating an awful lot of its trade in US dollars, either directly or, more importantly, indirectly. Now, when I say indirectly, just think what may be happening, for example, with the Saudis. The Saudis may well be, using renminbi or yuan, in the denomination of trade in oil trade, but they're not holding those yuan. They're converting them back into dollars or gold. And that's the fact. So what you've got is a situation where whenever China's trade surplus goes up, the dollar tends to be strong as well. And these are considerations to start to think about. It's not really straightforward. China is a big dollar user, and as far as I can see, it will not get off that hook quickly. So what's the outlook for China? I still think cloudy. I'm optimistic that they're actually moving in the right direction. The Chinese have thought about this a lot. They're eager not to make the same mistakes that were made in Japan, and they're closely watching that. So I think what they're going to do is to basically allow the banks to monetize the debt, and that will also help to add liquidity, but it will also improve the debt quality or the asset quality of the banks, because they're holding government safe assets rather than very questionable or dodgy real estate loans.
Mm. And what about Japan? How's Japan looking? We saw that big yen carry kind of blow up in the summer. A lot of people were talking about all this repatriation of money back to Japan. What are you looking at when it comes to Japan?
I must say I'm a lot more skeptical about the role of Japan in all this. I mean, I don't think that the yen carry trade is quite as big as people make out, particularly now. I mean, whatever the size of it, a lot of it was closed in the summer anyway. And I think what you're looking at is prospectively still a weaker yen. I mean, I just don't think that the Bank of Japan is able to raise interest rates significantly, because they've got the same debt problems.
Everyone's in the same boat.
How can you raise interest rates and just increase the interest bill on government debt? I mean, this constrains or ties the hands of policymakers worldwide. And this is the problem. So what you've got is a regime where debt is being increasingly monetized. Now, whether that is directly through central banks owning the debt, or it's indirectly because there's so much short-term funding going on that the banks tend to buy it. And this is an important, but as again, slightly wonkish point, is that if you sell debt to long-term savings institutions like pension funds or life insurance companies, it is not monetization. It's basically just using existing savings. If you sell the debt to banks or credit providers, it is a monetization because the bank's balance sheets expand and that expands money supply. Now, what type of securities do banks like? They like very short-term debt and bills. So if you're issuing a lot down those conduits, you tend to find that banks will indirectly be monetizing that debt. And that's what's going on right now worldwide. And that we know from history is inflationary. I mean, Milton Friedman will be turning in his grave looking at some of these numbers now. And this is, as I say, this is not hitting on the US. The US may well be, one of the cleanest shirts in the laundry, but this is a worldwide phenomenon. And that's why I think, what you've got here is a situation where underlying inflation is picking up. And that's why investors need these monetary inflation hedges in their portfolios, be it gold, be it Bitcoin, be it prime residential real estate, be it high quality equities that have got pricing power. These are critical parts of the asset allocation process now. Even by tips, U.S. Government index-linked bonds look at great value at 2% real interest rates, simply because it's really hard to get a 2% real return anyway in financial markets. If you can get that and it's guaranteed by the government, great, take it.
So, Michael, if we just wrap up here, what is the biggest risk you're worried about?
I think the biggest risk by far is inflation. That effectively the Fed is ignoring it. Equity investors are so far ignoring it. I mean, so far quite rightly, but at the end of the day, it's a major bogey for the markets. It's a hurdle we've all got to clear. And valuation levels will be pared back downwards. Markets will be derated lower in a higher inflation environment. And that's the real danger. We saw it. We've seen it many, many times before. We saw what happened in the mid-1980s or 1987 when markets perceived that the Federal Reserve had lost control. That was the 87 crash. We saw what happened during the 1970s when inflation was raging. Markets did not perform very well. A lot of volatility. And this is the problem. Financial assets do not like or do not perform well in a high inflation environment. We may not be sort of 1970s inflation levels, but we're pointing towards that. And that's the danger.
And what does perform well in that? I suppose this would be a bull market for real assets.
It would be real assets. It would be gold. Potentially it would be Bitcoin. I mean, what you want is monetary inflation hedges, because what we're leaning more and more towards is a regime of monetary inflation, because that's all policymakers can really do in terms of funding themselves. They effectively have got to monetize debt. We're in a world where we're debt junkies and we simply just can't pay it back. It's got to be monetized and somehow disappeared.
It's so interesting that you mentioned Bitcoin, because up till now, it's really just been correlated with risk assets. Does it seem like the ground is laid for that to finally function as an alternative or as a real asset or an inflation hedge?
Well, I think the short answer is we already don't know. I mean, because it's on new ground. But from what we've seen in the last 5 to 10 years, Bitcoin has moved up and down with the cycle of global liquidity. That's for sure. Now, gold has a much, much longer track record, which will last thousands of years. And we're pretty sure that gold is a fantastic long-term monetary inflation hedge. It always has been. There's evidence what's happened even since year 2000, where you've seen federal debt increase by 8-fold, and the price of gold has gone up by 8.25 times. So it's basically marched in step. Bitcoin, obviously done better than that, but it's a new asset class anyway. So I think one ought not to read too much into that performance. But at the end of the day, it does seem to move pretty closely with the global liquidity cycle. And therefore, we'd expect if there's monetary inflation, that Bitcoin should do well as well.
Amazing stuff, Michael. This is so important, and I think really important for people to consider as they look into 2025, because these are some of the risks that you track but aren't obvious, I think, to the rest of us. So thank you so much for that.
Great pleasure, Maggie. Enjoyed it.
And everyone can find more of Michael's work on Substack as well. Capital Wars. It's something we're all going to have to pay attention to, I think, as we consider this part of the market and these really important signals that are being sent. Thanks so much, Michael.
Good. Thank you.